Property Investing Insights, your authority on all things property investing, finance and wealth creation with Right Property Group.
G'day. How you going? I'm not from Right Property Group. I'm Phil Tarrant from Momentum Media.
Part-time Phil.
Part-time Phil. But welcome. Property Investing Insights with the Right Property Group. I'm one of your co-hosts here. We've been doing this for many years. Navigating property wealth creation now as well. Is that the business we're in, Steve Waters and Victor Kumar? Business of wealth creation.
I personally don't like the wealth creation.
ASICS hates it as well.
Yeah, I think it's really about hoping people can create choice.
Choice creation.
Choice creation. Well, at the end of the day, what does wealth give you, right? It gives you choice.
Gives you choice. I get that's what wealthy people would say.
It's a long road between beginning to end, though.
It is. It is a long road, beginning end. And as a man in charge of his choice, Victor Kumar, you've been on a wealth creation journey for many years.
For many years, right? And
you arrived as a young 20-year-old off the plane from Nandi. I read the book.
That's right. That's right. Yeah. When I was 26 years old or so. But yeah, that's history, right? But I think, in all seriousness, talking about wealth, we need to define wealth for ourselves, right? As to what wealth means to us, what lifestyle means to us, and not get caught up in cliches of, number of properties, dollar amount, all this sort of stuff. We need to really ride back to what's the journey look like? Where are we heading with this? What sacrifices do you want to make along the way? What wins do you want to have along the way? Because if you map it out, it becomes far easier. And you can't have a wishy-washy goal of, I want to be wealthy. Right? There's no tangibility to it, right? So you need to have an aiming point as an absolute. And, the old saying, if you want to land on the moon, shoot for the stars. If you go wrong, you'll still land on the moon.
Mm. I think
it's very deep.
It is. I know, it's just philosophical.
Must be a full moon out there.
It must be. Well, it was actually a double blue moon or somewhere like that last month. Yeah. So, as someone who's dialed in with the astrology of life, but you talk about wealth, Victor, and wealth's a funny thing because most people's wealth journey changes from when they start to where they end, and you must see it all the time in the clients you work with. People probably come in with this perceived idea of wealth, what wealth means for them or to them, and then actually understanding the mechanics of wealth and then how that changes quickly. And you see people, as they become wealthier in financial terms, they certainly change their mindset around what wealth means. And again, it comes down to optionality and choice, right? Yeah,
absolutely. And when you're starting out, obviously, you're not sure what is all your full potential. And as you gain experience, as you go through the take the hits, take the wins, and you get more dialed into the advice around you, obviously that does change the outlook. It changes the journey somewhat as well. You can become more adventurous or less adventurous depending on how your outlook is, and you become more realistic in the sense that you're not really most people that I see, initially when they're aiming for a goal, they're not really connected to that goal because they're not really sure how the journey is going to entail. And it's usually around property number 2 or 3 that the penny actually drops and say, hey, I got this, right? If I just simply follow this route, this is where it's going to end. Or I need to strategically change my direction, not the strategy, the direction. And that'll get me to my goal faster, or I can take a more sedate pace and go down the path of taking a longer time to get there. Now, everyone talks about, I want to retire early, I want to leave stuff for the kids, and the reality is that you first of all need to define what retirement is, and then the biggest fallacy is, I want to leave stuff for my kids, right? And Steve, you and I see this a lot, right? Once you're gone, usually if the education isn't there for the kids, they're clamoring to get to the money. And what's the easiest way to get to the money? Sell down all of your hard work.
Coming back to the goals, though, what I see is the connectivity to someone's goal is usually the most tangible thing, which is their income. Right? So it's very easy to say, I want to replace my income. I want that as passive or residual or whatever it may be.
And a good starting point, isn't it?
It's a great starting point because, once again, it's tangible. You're earning it. But what I do see also, nearly 100% of the time, is that goal changes.
Yeah.
It doesn't become the most important thing on that journey, so to speak. It might be that, they have triplets, or they want to sail around the world on a sabbatical, or they want the bigger home, whatever it may be. And so what's important, and Victor touched on this, is that the strategy you deploy has enough flexibility in it just to slightly move left or right to accommodate whatever those changes are. And nearly every single time it's around cash flow and growth, or cash flow and equity position, like without fail. So if you've chose a strategy that is either one or the other, let's say that it was pure cash flow or pure growth with quite a strong negative cash flow component, and you need to change that strategy or flex that strategy slightly, you're stuck. And what usually happens then, depending on how big a goal change you have, is that people can tend to then start to sell down the portfolio, which in some cases may be the right thing to do. More often than not, though, you're selling tomorrow.
Yeah. And this is the challenge when you're in markets which have a state of flux. And I guess what you guys are talking about there is this sort of life cycle of being a property investor. You start with, this kernel of an idea, and for most people the catalyst is probably, I want to be wealthy, whatever their version or definition of wealth is. And every single person I know who's gone down a pathway of using property as a vehicle for creating wealth, version of wealth changes all of the time. And it's when you get into markets like we're in right now, which I'd say that the change is stabilising. It's becoming very normalised now, where talk interest rates, we're towards a terminal rate. It's probably not going to go up too much more, and there's debates and discussions around that. So most of the changes happened. So therefore, people have probably calibrated or recalibrated their version or sentiments towards that and what it means for their wealth position. Have you seen, Victor, and we're talking about how people go through a life cycle of investing. Has there been a sense of stability or instability with your clients over this period of time? Are the good ones with strategy being able to flex left and right a little bit and just keep moving forward? Have they had to holistically change their strategy or how they're investing in property?
No, certainly not how they're investing in property. Certainly there is change in terms of holding cost. But this is where, as a journey, we forward predict all of these things, right? So it's still within budget, within the household budget. And it could be that we are making some small changes within the portfolio to then propel forward. The recognition here is that this journey is not linear, right? You take deviations to cater for, as an example, coming off the 2% to your standard rates now. We may need to take deviation in the sense that, okay, you've got a little bit of a holding pattern, or we know that we're well set up because we've worked on this portfolio for a little while. We are really well set up, and now's the time to put the foot on the pedal, right? Absolutely accelerate, because you've got less competition from the other buyers. Yes, of course, the other side of the equation is that, arguably there are less properties there, but we're recognizing the work that we've done in the yesteryears in terms of how, being in inverted commas counter-cyclical, we've made advances in leaps and bounds in terms of equity position, in terms of cash flow. Now, this cash flow is not the same every year because it fluctuates between what you're doing in the portfolio and the interest rates. But that's the proof in the pudding to say that, okay, if I repeat what I've done in the yesteryears, and I make these small adjustments to cater for the time of investment today, I'm going to be far better off in the next decade of my investing, or the next couple of years of my investing, because I've got this foundation in place, right? And for someone that's just starting out new, it's recognizing that fact that you've got to put in the foundations in first and then propel forward.
You said something really pertinent there in and around timing of the market. And we've all heard, and we've actually done a podcast 4 or 5 ago around time in the market and timing the market, and how most people actually don't understand what that means. And as a quick refresher, it's really not about the market, it's about the components that are going to drive the market. And so if we bring that forward to today, and furthermore from what Vic talked about around, is it time to accelerate in your own personal in terms of your own personal circumstances, or do you need to back off and hold off? Well, only you can determine that, right? But if we look at the components in terms of timing that market, they don't get much better. Coming back to what you said around the life cycle of your typical average investor, from a financial planning point of view, what the life cycle of an investor really is looking at is the planning, the acquisition, the distribution, and then the legacy components, which is, once again, from a financial planning sort of avenue, and all very pertinent and all very important. But if we actually dig down deeper into the individual and have a look at the life cycle of your average investor, and it is very, very varied. There are those that their life cycle is many, many decades, and there are those who would struggle to make it 5 years. And in fact, if we look at today's market and have a look at one of the data points about stock on market, and take Sydney, I think it's some 30% of properties on the market in Sydney is investor stock. So the investors are selling down their property or properties, and the question is why? Is it around cash flow? Is it around fear? Is it around because they have to protect the castle, which is the home, or do they see the cycle now being status quo as is right now for the next 10 years? And I'd argue that it's those people that are thinking that today's market is going to go sideways for some time are the ones that haven't thought long and hard enough, and potentially haven't surrounded themselves with the right people to give them the right information.
Yep.
Because once, as I said earlier on, they're selling tomorrow.
This sort of notion of the life cycle of a property investor is a real tough one, because it's definitely not linear, and you might have a plan, but the market also has a plan, and you have no influence on the direction of the market. So you need to build a strategy which is robust enough to be able to manoeuvre left and right, operate in a grey depending on what the market is, but stay strong and stay to the course. Now, we've spoken about it for years around, being in the market for a long time is probably one of the critical success factors of being an effective property investor, if you make the right decisions through that whole process. So I completely subscribe to the idea is that I still don't think a lot of people get the right advice.
They don't. And on your point about not being lineal, and this is where, and we've talked about this in the past, this is where I think people don't get it, is that, especially those that haven't educated themselves or digested the right material, whatever that looks like, is that they'll grab a data point and they'll say, well, okay, Australian residential property over the last 50 years has grown by somewhere between 6.3 and 6.8% compound growth per annum.
Is that a fact? That's pretty much
somewhere in that range.
6-ish,
Yeah. So what they'll do is they'll grab that data point, they'll grab a compound growth calculator and say, well, I'll go out and I'll buy a $700,000 property and I'll just plug those numbers in, and this is what it will do every single year to an end point, right? But what they're not taking into account is, yes, the trajectory is up, and it could be that 6.8%, but it's not a straight line. There's ups, there's downs, there's sideways. Yes, historically looking backwards, it's given you that amount, but you have to ride those peaks and troughs in between, and those peaks and troughs aren't necessarily about the asset value which affects people. It's not that. It's the actual cash flow that it produces in combination with whatever the cost of money is at that point in time. Yeah. And that's where the problem is they don't, if we want to use the word model, they don't model out those inconsistencies in the market, be it the finance market or the asset value, to cater for those periods of flux and where things aren't as well. Take the GFC for an example, and for anyone that was, I guess, old enough to be in some way, shape or form, the market of the GFC. If we go back, and we've used this as an analogy before, very, very few people sold their properties from a lack of equity position or from a lack of growth. It was from a lack of cash flow management, right? So not being able to weather that storm of how it looked back then. Had they been able to do that, fast forward to today, and those properties have doubled and tripled. So it is a matter of being prepared for the worst, accommodating that so that you can have this timepiece in the market and reap the rewards.
So time in the market, to generalise or simplify, time in the market is going to be completely based on your ability to hold property.
That's what it is.
And your ability to hold property is intrinsically connected with your ability to get serviceability from banks, your ability to pay your debts, your ability to normalise fluctuations of the family budget, your ability to normalise interest rate increases from the central bank. But the critical success factor in property investment is holding onto your properties for a period of time to realise the outcome.
Which is done via cash flow management. And preparation. So we do get times in the market like we've gone from 2% to 6% in terms of the cost of money, which is, when you sit back and think about that, it's massive, right? So had you, and I know we've banged on about this forever, but had you have actually sat back and thought, you know what, this can't last forever, this cost of money, and we know that rates are going to go up. We know the world is printing money left, right and centre, so we're going to get inflation, so we're going to get a higher cost of money in terms of our loans. We should prepare for that. How do we do that? We put aside buffers. We draw down equity, we make ourselves liquid, we park it into itself so that you can ride out whatever the crisis may be. Once again, going back to the GFC, those that did, reaping the rewards of today. And this comes back to my point that nothing is ever linear. It's not this straight line approach in terms of growth and management of your asset, whatever that looks like. You need to be aware that it's up, it's down, it's sideways, and prepare yourself accordingly.
Yeah. Look, talking about life cycles, and this is the life cycle of an investor. When we are starting out, often we try and emulate the success stories we've seen on Facebook, the media, and so forth, right? So let's say the article you read was someone that's made really good progress in a Sydney market. But that might not even apply to you because you might not have that much of a slippage in terms of the earning capacity that you've got and the holding capacity that you've got. So what I'm talking about here is the money left over to invest, cash flow-wise, not capital. I'm talking cash flow over here now. So that would mean that you're out of Sydney. You can't afford Sydney, right? So therefore you're looking at a different market, and therefore your strategy and the areas that you're investing in, the types of properties you're investing is very different to someone that's earning double your income and has got also double the ability to hold the cost, right? Now, the reverse is also true in the sense that someone could be earning double what you're earning and not be able to hold onto a high negative cash flow property. And I say that tongue-in-cheek because they've got a lot of other ancillary expenses, private school fees, the car leases, whatnot, right? Whereas you as the starting investor, you've contained of the expenses, so therefore there's a lot more money available to help hold onto the property itself. Then it comes back to, okay, well, you're earning less money gross amount. It does have a natural cap in terms of your borrowing capacity. So there's so many different moving parts that we really, when we're starting out as an investor and even during the journey itself, we need to come to terms of the limiting factors that we have in our journey. And the biggest limiting factor is the ability to borrow money. And the next biggest thing is the cash flow ability.
It's how to pay for it.
Yeah.
And that ties in with the life cycle. If we look at the average investor in terms of, I think it's the ABS data, they hold their property for around about 5 years before they say investor, before we say we're out. For whatever reason, they might have made $1 million, they might have lost $1 million, they might not be able to afford to hold it, or they just want to move the money on and redeploy, whatever the reason. But it's about 5 years. Now, if you compare that to, or if you run that alongside realistically how long you need to control a portfolio for to really make it worth it, which is decades, especially towards the tail end, that life cycle is very, very short. It's almost hardly worth doing it unless you were quite speculative or you had some luck and you made a bit of money, right? And you're in and out and it's done its job. But then you're not an investor, you're a trader.
Yep.
And there's a very, very big difference between investing and being an investor than buying for the sake of it. And I would argue the fact that most investors really aren't investors. They're controlling or they're buying an asset based on what the majority of other people are doing because they're reading the media or whatever it may be. Which brings me to a point around today's media and the lifestyle, and sort of encompassing that into the life cycle of the investor, because it is often driven by media sentiment and then public sentiment. And if we bring that into today's environment where we take, I don't know, the latest Westpac report where Yeah, I say this tongue in cheek. 6 months ago, we were going to lose 15%. 4 months ago, it was going to track maybe sideways or for a couple of percent. And now, depending on where you look, it's plus 10, plus 8.
On price growth.
On price growth, equity growth.
Yeah. That's a big change.
It's a huge change. It's a massive swing. But what it does show and highlight is that the complexity in behind market drivers, it doesn't matter who you are, what you are, an economist, a banker, a whatever. There are so many nuances in there which can change, especially today in a heartbeat, which will drive a market in different directions. Those of us, I guess, that are in the industry, and this is all we do, is we study these, I guess, patterns and nuances. That's all we do. There's not. You could ask us all, and I would suggest that probably over 90% of advisors would say, we saw this coming. Without fail, we know where the market is going. There's just one little component we're waiting on for, and it's going to be a very different
We
market.
spoke about that about 3 or 4 months ago, where you guys were predicting or are predicting a period of considerable growth in the Australian market. The one thing holding them back at the point in time we spoke about was liquidity, access to money, right? And you're seeing that sort of already changing. You would have seen Macquarie coming out recently, sort of with their fixed rates sort of down under 6%. You see a lot of operating within the grey now around refinancing with banks on serviceability requirements. But as we're discussing around this, it's going to sound quite inceptionist, but most people consider a life cycle being you start and you end. And there is a part of that with property investment. There's a starting point and an end point. But right across the whole journey, there's mini life cycles. Everywhere you look, there's a mini life cycle on your ability to secure debt, leverage debt, pay down debt, and that changes. A whole bunch of things. Every property itself goes through its own life cycle. Every market you operate within goes through its own life cycle. It's always changing. So whether or not life cycle is the right term for it, because it assumes that there's this pathway that start and end, if you're going to map property investing, it would be a web. It would be a web with nodes all interconnected. And if you looked at it, if you mapped it out properly, you'd go insane. It would be that complicated.
Well, you certainly wouldn't be able to create this static plan looking forward to be able to purchase. And I guess this is why Vic and I have had discussions around these perfect modelled out plans, because there's too many inconsistencies and assumptions. I don't know, throw in COVID. Rework your plan time. Throw in triple of interest rates, rework it again. And so I think going back to the earlier point, having enough flexibility in your situation and your strategy to be able to accommodate those moments in time is...
And that's the best planning,
right?
whether you can look at any type of discipline, whether it's the military, how you create big plans, but they don't last the first sort of rifle shot, right? Like things just turn into a mess. However, the discipline of the training and the doctrine of how you fight sorts you out in the dynamicism of conflict. The same happens in business. You need a plan, but you need to be able to operate in and around the greys through good disciplines, good habits, good cultures, good whatever. Same applies in property investment.
I think you've just made a really, really interesting point there about the discipline of being an investor, no matter what the asset class is. Those without the discipline lack the overall result. And then I guess bringing that back to the Australian Defence Force, if I look at, I don't know, countless Australian Defence Force clients that I have, and some are at the very tip of the spear and some are at the other end, I could nearly hand on heart say that every one of those clients that are in the ADF are fantastic investors.
I bet you they are.
Because
they're methodical.
They're methodical. They're regimented. They're disciplined.
They're coachable. They're
coachable. They're not reactive.
Yeah, and they
Except in the right
appreciate
sense.
education and their mindset. And it's a really good point. People in the ADF spend most of their time training to fight, right? So they can fight. But it's all developed through systems, processes, doctrines, culture, how we fight, how we approach these things. It all applies into property investment. It's funny you say that, because I imagine they would be good clients to have.
They are. They're fantastic.
Because if they
clients.
respect you and they see sense in how you go about doing yourself, they'll embrace it, adapt it.
And they're also goal-orientated.
And they're goal-orientated.
And they
outcomes-orientated.
Outcome-orientated, and they hold themselves accountable. They're not blamers.
Accountability is key, and it's, you know,
Yeah.
in terms of developing a life cycle, this notion of life cycles in life cycles in life cycles, you've got to embrace the grey.
That's right. Yeah. Look, Phil, you said something really important that I want to touch back on, which is the decision making, right? So people decide to go on this journey, and what's really important here is that we're making the big decisions in the beginning, right? Where we're heading, what we're doing, how we're doing. And then we need to be dialing back in to make sure that we're making the smaller decisions that we need to make as the portfolio progresses, right?
Yeah.
Most people, if they're not educated in terms of investing, they think that all of the decision-making process is just in the beginning and there's no more decision-making along the way. And so you need to really prepare yourself to be able to make the decisions, simple decisions like, you know, rental increases, refinancing, restructuring your mortgages, whether holding fire or accelerating, they are part of your daily decision making. And then also not getting caught up in the hype of the day and making sure that the property that you're buying is actually in line with your working age as well, right? So if you're young, you're starting out, you can afford to go into into more of a set and forget strategy. Whereas as you get closer to retirement age, the strategies that you implement, the properties that you buy, they become so exact. And then when you look at all of those things, a whole lot of people, when they're starting to invest, they are assuming that something magical will happen in the end and they'll get to their holy grail of retirement or lifestyle. You've got to actively work towards that. You need to have an active plan to say, okay, this is how I'm going to get to my income. And there's no secret, right? You've got to pay down the loans or substantially increase the cash flow without putting the foundational properties at risk. And this is where constant touching in with the properties, constant looking into your ability to hold onto the portfolio, best case, worst case, and also constant re-evaluating of time that you're going to commit towards this journey as to whether we are halfway there, whether we need to extend the time frame, whether we need to bring it closer, so that you're looking at all of the moving parts on a regular basis, so that you're not becoming complacent and running a race where the rules for the game have changed.
Well, the best game to play, Victor, and I learned this a long time ago, the best game to play is a game that you can always win. So you set the rules, you play by the rules which best suit you, right? And so absolutely that applies in property investment more than anywhere else. And what a lot of people get caught up in and don't really understand with property investment, they worry too much about the former and they get excited about the former and they don't want to do the latter. And that is they get absorbed with what's my future look like, you know, the goal setting. How am I going to do it, the strategy? And what they fail to remember or they forget, or the ineffective ones, and these are probably the one they sell after 5 years in the market, that's all nice, right? But that's not your full-time job as a property investor, is to dream about what the world's going to look like.
Correct.
It happens at the execution level. How do you tactically execute to get the outcomes you want? And that's the hard bit. And that's the bit that's fatiguing. That's a bit, pardon the French, shit sometimes. That's a bit which you feel as though you're getting no upside out of it. That's a bit where you just get fatigued by it. That's a bit which is hard. And that's the bit you've got to nail. And that most people don't understand, talking about life cycles in life cycle, that's where the magic happens.
Yeah.
If you don't get that right, it's not going to work for you.
Do you know what? The execution is constant. It's not something that, because as you say that, people are going to be listening saying, okay, the execution is in the beginning, you know, planning and then execution.
That's not executing planning. That's just giving you direction.
Yeah, but planning is direction. Executing is, I guess, implementing the plan on the top line, right? But execution is a constant. It's executing change. It's executing purchasing again, consolidating it. So it's, I guess, the plan with those micro changes needs another execution point. Yeah. It's time to execute again, whether it is to more education, execute. So there's a lot of moving parts, but I think if we bring it into today's market, because everyone's like, oh, cool, that's really good, that's great talking about hindsight, but what about today? Yeah, where are we going today, and at what part of this life cycle are we at? And it depends. If we look at...
You're talking personal life cycle or the life cycle of the property market?
Bit of both, because I think they go hand in hand, right? It's not even, I think, they do go hand in hand. depending on who the person is and their personality. So if we look at today's life cycle and we look at what's happening within our business, and I don't know if I touched on this earlier on, those clients that we have who are in a position are super buoyant. Like they want to go and they want to go now. We want to purchase now. So in terms of our existing clients, we're super busy. Like they understand the components because they've had enough education. Yeah. They know where they are in their life cycle. They know where the property market's life cycle is. But what's actually quite interesting, I guess it's because of podcasts like these and others and the education that's out there quite freely, is that there is a tremendous amount of first-time investors, or maybe even second-time investors, that are just, they want to go. They want to do it now.
Yeah.
And I put that down to, I think I might have mentioned it a couple of times, a couple of podcasts ago, is I truly do believe that the majority of people know where the market's going.
Mm.
Not
where's it going?
Down. I just like celebrity run away. No, I think most people know. And we often refer to having all these different components, and we've said it many a time that I don't think in history, certainly not in our 24 years doing this, that we've had this many components come together at the one time. And people really need to hear that. We've had these components, maybe two at a time and one at a time.
But people are going to go, yeah, of course you're going to say that, Steve. You're in the business of helping people find property, so of course you're going to paint a picture that it's a good time to buy.
No, not at all. I mean,
you guys can be quite contrarian. I've known you for many years. So,
it's like if we think it's like don't buy, don't.
But this is life cycles, right? Don't buy in some markets, buy in these markets. Again, it's a life cycle specific.
That's there you go. I'm sorry, mate. It's not like we got show notes here. Yeah. But if we run the investor's life cycle in and around where the property market's life cycle is, and we have those different times of the life cycle dictates the different type of investing approach you should have.
Yeah.
So we could have value investing, we could have contrarian investing, we could have growth at a reasonable price investing, and we can have momentum investing. And the question is, at this time of the life cycle,
which one is it?
Which one is it?
Yeah.
I'm going to say that there's a little bit of everything in there, but we're getting to the point where it's going to be a momentum market.
Do you know what I add to that? I think that's well framed, Steve. I would also impact, and it's more of a funds management term, is impact investing. And impact investing and like NDIS properties, right? For example, which is, hey, you're investing in the purpose of property investment. However, there is a community upside on that as well. You're providing specific properties for NDIS, for disability, people on disability benefits. So there is such a thing as impact investing also in property, or people go down a pathway of building fractional type houses where there's a whole bunch of little things, I don't know that much about it. Brick by back, but it's a really good way to frame it. But, I want to pick you up on a point. I think this is probably one of the biggest misnomers in property investment, where people who probably don't know about property investment, and the critical thing about property investment is education, right? The more educated you are, and the better your network of people to help you out on that, whether that's at a foundational phase or actually at an execution phase, you're going to be better at it. Now, people talk about counter-cyclical investing, right? Which I think is an absolute misnomer, because the point being, when everyone else is saying don't invest in property, you should invest in property, right? And that's the point you're making. Smart people now are going, hang on a second, this is the right time to be investing in property. That's not counter-cyclical. That's what you should be doing.
Yeah.
So that's when you should be buying property. When it's counter-cyclical is when you're doing the opposite of that, right? Which is what the herd typically does. So don't get absorbed or too obsessed with this idea of counter-cyclical investing, as in, I wait for the right opportunity. When dumb money's going into something, I stay well away from it, right? Counter-cyclical proponents would say, okay, now's the time to do it when other people aren't doing that, right? That's not it. The reason why you listen to this podcast is so you can be educated to know that this is the time.
Yeah.
So it's not counter-cyclical.
Yeah, and look, very, very few times have you, I would argue that Vic and I have been in any form of media, whether it be this podcast or our Facebook Lives or whatever it may be, or market commentary, where we've said, like, if you don't do it now, you're a fool. Right, there are very, very few times. I believe there's always a time to invest because there's always a market, as we know. Markets within markets, blah, blah, blah. But when we look at it from a very sort of top-level, holistic, big general pool of commentary, it's looking pretty good.
Yeah, all the fundamentals are there.
I know, and I mean, and as you going back to your comment saying, "Oh, yeah, but you're saying that because you're in the business." The banks are saying that it's looking pretty good.
Oh, the Commonwealth Bank's had a horrible year for property investing.
Right,
Horrible year.
And I'm not saying that whatever the bank says you should do, sell, buy, whatever it may be. But let's
but to the point,
let's
right?
not forget they make their money.
Exactly.
Lending money.
By lending money and $10 billion profit, right? Like, no, it's not bad going. I'm a CBA shareholder.
I got a bit of that.
Most people will have CBA shares in their super fund, whatever it is, retail or industry or whatever it is, right? So everyone gets the upside on it. But they've had a pretty good year because interest rates gone up, right? It's a part of it. It's a bit base, but that's the way it is. However, and this is the point, we had our big Australian broking awards the other week, and I was chatting with the MC, and I was like, you know what? Like, a lot of people sort of think mortgage broking is really boring, it's unglamorous, and this, that, and the other, right? But mortgage brokers write 70% of all home loans in Australia. I know you guys have a very successful mortgage broking business, so you know this well. They write 70% of all loans, right? If you go through CBA's book, it's a lot lower actually because they're probably less broker focused than everyone else, but it's irrelevant. The value of the bank's balance sheet is largely their ability to lend money, and most of the lending is inside of residential mortgages, commercial a bit, but residential mortgages, right? So the health of Australia's bank is driven by their mortgage books, and the mortgage books enables people to buy property in Australia. They're inherently connected to banks with the success and the outcomes of Australian property. We've spoken about this before. Mm-hmm. Government also is highly incentivised. 93%, whatever it is, of all rental accommodation is provided by mum and dad investors, people like us, right? So everyone's in this, right? Everyone is connected with the Australian property market. So counter-cyclical investing, when do you invest, when do you participate, how do you get involved? I think the inflection point for most people when it comes to life cycles is, oh, hang on a second, it's this thing called property. So people have already gone through this because they listen to this podcast. There's this thing called property. How do I capitalise on it? Am I comfortable with it as an asset class? I sort of gave some reasons why you probably should be. But now what do I do about it? But you still see Johnny comes lately in and out all the time, trading in 5-year cycles, right? Hopefully, how do we get people to understand and appreciate, Victor, that life cycles in properties are measured in decades?
Yeah, absolutely. And this is, again, coming back right to the beginning where, we need an aiming point, right? And then have the check-in. It's not just a set and forget, hey, this is your plan, go out and buy, right? So we need to be dialed into exactly what we're trying to achieve. And that will change along the way as life takes its toll, right? You get your kids, a change in career, you're upgrading the home. So it has its hiatuses along the way. You can't qualify for finance. But all of those changes, the fluctuations, you're still aiming at what your outcome is. And it's not the number of properties, right? It's not the amount of equity really, when you really think of it. It's actually the cash flow, because the reality of it, right? You've got the wealth effect of investing, and then you've got the lifestyle effect of investing. The lifestyle component only comes from cash flow. If you were to look at it, count wealth and define wealth with equity, then you really need to think of it. And a really good example of this would be your super fund properties, right? You can't spend your wealth in the super fund. You can't get to the equity unless you sell. And that's true in outside of super as well. Yeah, and this is where having that journey, making sure that if you are investing, and one of the things that you said was that, a lot of people say, okay, when do I get started investing? It's more like, where do I get started based on my circumstances, finance, capital available, what's happening in life, and therefore that all drills down to affordability. And whether I need to wait a few more months or a year or so because of circumstances, or do I need to jump in straight away? The idea being that the longer you're in the game, the more end profit that you have. And if you look at people that have been only in the market and they sell as soon as they've got an iota of growth, perhaps they're not as clued up in terms of what true property investing is. It does have a cost. It does have a cash flow cost. It does have a time cost. And it does have a mental cost, because you need to be making decisions along the way. And all of those things are addressable. You can address that if you're not good at those things. Surround yourself with people that have got the scars to be able to guide you through all of that. And it's a growth phase, right? As you go into property, you're growing into making good decisions, better decisions as the portfolio unfolds. And if you've got someone like even a really good tennis player would have coach or coaches to help them. One coach to help them with the backhand, the other coach to help them with returns, all of those things, right? And it's the same with property. You'd want a property advisor that's an all-rounder that's been around for a while to see the fluctuations themselves personally and not operating out of a textbook, because you want someone to be operating out of life book, right?
And the mistakes.
Yeah. And then you've also got to plug in the other team players being your mortgage broker. They need to understand the journey that you're about to embark on, and not be focused on how a cheap rate can I get you, because that's the instruction you've given the broker. They need to be able to say, well, yes, I can get you a cheap rate, but what are you trying to achieve? What are we doing over here?
Fit for purpose.
What's 1 year, 2 years, 3 years look like for you in this portfolio, and accordingly act out the finance. And then, of course, you've got to plug in the accountant, the right type of accountant, when you do need him in that mix to help you play out. And I guess one of the things we're talking about earlier, before Phil shouted the coffee, which was, we had to coax it out of him.
Deep pockets, short arms.
That's Phil. So we were talking about how a lot of people have absolutely maxed out their borrowing capacity in the personal space. Yet they see what the market is doing. They see if they are able to jump in, they should. And we are starting to see this big surge of people actually getting good advice and jumping into the self-managed super fund space, because then they're continuing the portfolio in recognition that at some point in time they will retire, and that becomes also part of the nest egg.
Yeah, and that's seek accountants' advice, all the time. But I think if we come back to this lifestyle sort of analogy, life cycle analogy, I would say the mental aptitude of the individual investor will determine their success.
It always comes down to aptitude, mindset.
But what do you do to get it? Like, this is the point. A lot of people that are in and out in that sort of 5-year term or whatever it may be, and there are genuine reasons why you sell, like point on the table. But no matter what the asset class is, if you, and further from Vic's point, if you don't have the coach, so to speak, using the sportsman analogy, how many successful athletes do you see without a coach? Or several, for that matter.
Yeah.
How many successful executives and businesses do you see without some sort of team environment that are giving them special counsel, call it, whenever needed? It's the same thing when you're investing, whether it be property, shares, fine art like you, Vic, Phil. It's like if you're not constantly aware of your own scenario and your own circumstances and being coached in inverted commas, then you're not really investing.
You always ask someone more knowledgeable than you about something you don't know much about.
But do you listen?
Yeah, that's the difference.
It's the quality of the question will determine the quality of the answer. Or are you just looking for confirmational bias? Because if you ask enough people, you'll find what you're looking for.
Yeah, absolutely. So just to crystallise this then, understand where you are in life cycle. Understand there's life cycles in life cycles. Understand that there's many things you can't control as you invest in property, but an appreciation and understanding of where you are and having the right team around you will ensure you make the right decisions at the right time. What's clear to me is that property is largely a forgiving investable asset if the cash flow is okay. So if you can hold property, if it's not putting too much pressure on you to hold property, you can maneuver through any life cycle, right? The challenge is that when you're distressed and you have to sell property. So the longer you're in the game, the better off you're going to be. And property is not really a game of finance, it's really a game of cash flow management. That's what it is.
Which you're 100% right, but then you could sort of stretch that out to finance.
To finance and to everything else.
And to everything else.
If you can hold your property, you should be okay. Yeah. Even if it's a dud property, you could probably sort of missed opportunity costs, yes. However, you can sort it out.
Over time.
Optionality is sort.
Yeah, 100%. And I think one of the earlier points you made is ever so important as well, is control what you can. because there's a hell of a lot you can't and you never will be able to.
Yeah.
But at least prepare yourself for those moments in time.
It's good. Thanks, gents. How do people get in touch with your team? What's the plan?
Well, the investor's life cycle starts with a conversation.
It does. There you go.
That was good, Vic. Yeah, that was good. Yeah.
See, that was just...
He's been waiting all podcast.
I've been waiting all podcast to say
handboard,
this, right?
yeah.
But in all seriousness, we are just a phone call, a Facebook or website message away. And yes, there is a little bit of a process. You get to speak with our phenomenal staff that are all life trained. They're all investors. So anyone that you're talking to in Right Property Group, they all have property investments. And you'll be initially talking to our business manager, Kate. Now, a little bit about Kate. She was 19 when she started with us.
I've known
15
Kate for
years.
well over a decade.
Yeah. And she's grown her
She's now
portfolio.
57.
She's killing for that. Yeah. But she's grown her portfolio under our tutelage. And so when you're speaking to her initially, she will help prepare for a conversation with either myself or Steve so that you come in armed with the right questions so that we can then give you direction.
Sounds pretty valuable.
It is.
Start your life cycle. But, you can restart your life cycles as well. If you feel as though you're not doing the right thing, speak to someone. Phone a friend. I guess you guys are friends, aren't you?
I don't know, are your friends?
I don't know. Depends how I feel on any given day.
Depends on who buys the coffee.
Depends on who buys the coffee. Thanks, gents. Go and check these guys out, Right Property Group. You can find them on the interweb or Facebook. I know they do. You still doing your live streams?
Yeah, we got one every second Thursday.
Yeah, was it
7 p.m.
Okay, all right. And at 7 p.m. live, you guys go into what is pertinent, relevant, and you can heckle you through the comments, which I have done in the past.
You have.
Yeah.
We just mute you.
Ban him from Facebook.
You're a lurker.
No, it's good. No, thanks, guys, for coming in. Go and check these guys out. Thanks for tuning in, everyone. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.